Good afternoon, everybody, and welcome to our latest installment of the Option Industry Council's webinar series. My name is Mark Benzequin. I'm the manager of the Investor Services Desk here at OIC, and today we're going to build on the concepts and the discussion that we had last week, where we discussed the core concepts of options. And today we're going to be talking about what's known as the language of options. We're going to discuss some of the processes, some of the terminology. We're also going to expand a little bit about what we talked about last week with buying and selling calls and puts based on some of the recommendations and the comments that you had made in our survey. Like I said, we're going to expand on some of those concepts just a little bit. We've got a lot of material to cover today, and I certainly want to leave plenty of time at the end for a Q&A section. So let's go ahead and get right into some of the housekeeping items that we need to cover first, such as our standard disclaimer. For those of you just joining us who are new to the OIC or new to options in general, you should certainly know that options involve risks and therefore may not be suitable for everyone. To find out what those risks are or to get a better idea of what you can expect from trading options, make sure that you have a copy of the Characteristics and Risks of Standardized Options booklet. For a free copy, you can contact your broker or let us know here at OIC, and we'd be happy to send you a complimentary copy. Also, to keep things simple, we're not going to be talking about taxes, margin, commissions, interest, anything that would affect your account in terms of additional costs. We're simply going to be looking at gross profit and loss. We want to keep the math as simple as possible. And then lastly, the items in the discussions that we're going to have today, simply for educational purposes and not intended as an endorsement or a recommendation. A little bit about OIC before we begin. We are the premier leader in options education. We offer free and unbiased professional options education. We don't make recommendations. We don't provide advice. As a matter of fact, we don't even have a product to sell. All we try to do is provide information to you, the investor, in order for you to make the best possible decision based on your individual investment objectives. We mainly do that through our website, optionseducation.org, where we've got online courses, podcasts, videos, and obviously the OIC webinar program. The pride and joy of OIC is our Investor Services Desk. You can reach us via email at options@theocc.com or live chat on our optionseducation.org website. And speaking of the Investor Services Desk, we've got Bill Ryan and Ken Keating on the line with us. They are going to be taking your live questions and responding to them in real time. Some of those questions we also will feature at the end for the Q&A. So the OIC supports the 5 major U.S. option exchanges, as you can see here. Each of those exchanges are a parent exchange for a total of 16 different option exchanges in the marketplace, and that's where all of the trading occurs. You can see in 2018 we had a record year of a little over 5 billion option contracts traded. Last year, 2019, fell just shy of that, but certainly a robust marketplace for option investors. If you're looking to get into it, you can see that you're certainly not going to be alone. Our outline for today, like I said, we're going to do a review of calls and puts, building on the concepts from last week. We're going to look at new options listings. It's a question that we get often at the OIC desk. How do we know which companies are going to be listing options, and when can we expect to see those? Opening and closing transactions, buy to open, sell to open, buy to close, sell to close. Also questions that we get often from beginner investors. How do I know how to enter that order into my trading platform? And then another process or concept that is also fairly confusing and complex to beginner traders: exercise and assignment. How do I know when to exercise, and how do I know when to expect an assignment? And more importantly, what do those terms mean? and then we're going to wrap it up with a view at moneyness. What does it mean to be in the money, out of the money, or at the money? And like I said, we're going to make sure that we leave plenty of time for Q&A at the end. So let's get right into it with calls and puts. This is a slide that those of you that attended last week, you're familiar with. We've got calls and puts, and when we break it down to the most simplest terms of an option trade, there's really only four things we can do. We can buy a call, we can buy a put, we can sell a call, and sell a put. When we're buying an option, it gives us rights just like any other contract. When we sell an option, we are creating obligations for ourselves. So you can see here, if we buy a call, that gives us the right to buy something. That something in this case is going to be 100 shares of the underlying, and that underlying being stock or shares of an ETF. So when we buy a call, we've got the right to buy 100 shares of stock at that strike price anytime before expiration. So we're making some assumptions here. We're assuming that we are dealing with American-style options, which we'll get into a little bit later, but American-style options afford us the right to exercise our contract anytime before expiration. And then again, we're assuming that we're talking about shares of stock or ETFs and not an index fund. So we buy calls, that gives us the right to buy shares. We sell those calls, that gives us the obligation to sell those shares at the strike price. Puts are going to be the opposite. Buying a put gives us the right to sell stock, and selling a put gives us the obligation to buy those shares. And let's go ahead and break those down individually with some examples here. This is what we would call a profit and loss graph. And again, for those of you beginners, this may look a little daunting and a little confusing, but it's really the best way to visualize at expiration where your risk and reward lies. So let's start out with this vertical axis. That vertical axis is going to represent your profit and loss, or your risk and reward. Anything above the zero is going to be a profit, below the zero is going to be a loss. The horizontal axis, that's going to be our share price. So for example, if we were to buy stock outright at $60 a share, that's represented by that green dashed line. And you can see as share prices increase above 60, we're going to make money. If share prices fall below 60, we're going to lose money. Again, it's the same thing with stock. If stock increases, you make money. Stock falls, you're going to lose money. The issue with that is when you're buying shares of stock, and remember, with an option contract, we're talking about each option contract representing 100 shares. So if we buy 100 shares of stock at $60 a share, that's going to represent a $6,000 investment in those shares. That's it could be a substantial amount of capital, especially with some of these stocks in today's market that are trading above 1,000 and even nearing 2,000. It's a substantial amount of capital to lay out up front. With options, we can control the same amount of stock, but at a substantially discounted price. So in this example, if we look to buy the $60 strike call for $3, that gives us the right to control 100 shares of stock at $60 a share. And for that right, we're going to pay $3. With options, again, as each contract represents 100 shares, the same with the dollar amount. That $3 in premium would actually represent $300. So rather than outlaying $6,000 to control 100 shares of stock, we are putting up $300 to control that same amount. Now, it's not necessarily apples to apples, so to speak, because, by being a stockholder, well, it gives us voting rights. By being a stockholder, it allows us to capture a dividend if one is paid. But being an option holder, we don't have those rights. We're kind of sitting on the sidelines when it comes to that. So, there's benefits and pros and cons to each. Certainly up to the individual investor to see which fits their particular risk profile the best. But again, with this example, we bought the 60 strike call, paying $3. Now, if we exercise that call, if we decide to buy those shares for $60 each, we're really paying $60 per share plus the $3 that it costs to buy that option. So our break-even point is going to be $63. That break-even point is the point at which we tell ourselves anything above that break-even point we're going to be profitable, and anything below that break-even point we're going to lose money. So in this case, with buying calls, that break-even point is simply going to be our strike price plus the premium that we pay for the option. So this example, $63 is our break-even point. As you can see, it's that blue line as it crosses that horizontal axis, that stock price. So anything above $63 will make money on the trade. Anything below $63 we're going to lose. Now the good news when buying calls is just like stock, our profit is unlimited. Once we go above that $63, we're going to make money just as we would with the stock. So as the stock goes up, so does the value of our option. The other good news is that when it comes to buying calls, our maximum loss is defined. So with options, in many cases, we know going into the trade how much we can make and how much we can lose. When we buy options, the most we can lose is what we put into it. So in this case, we bought an option contract, $3 premium, $300 total in the real world. So you can see there, anything below that $60 strike, as shares fall below that, our risk levels out to where we lose $300 and $300 only. Certainly substantially less than the $6,000 that we had at risk with the long stock position. Okay, so buying calls, we've got the right to buy stock, in this case at $60 a share. For that, we're paying $3, gives us a $63 break-even point. Maximum profit, unlimited, maximum loss, limited to what we put into the trade. Now let's look at the flip side. If we sold this option, our break-even point is going to remain the same. We're selling stock at $60. But for that obligation, not the right, we're selling, so we are obligated to sell stock at $60. But for that obligation, we collected $3. So theoretically, we're actually selling the stock at $63. And again, you can see that's where our break-even point is. The downside to selling this particular call, when it comes to buying options, the premium that we pay is our maximum loss. With selling options, the premium that we collect is our maximum profit. So when we buy options, we can't lose any more than we put into it. When we're selling options, we can't make any more than we collected. Also, you can see our maximum loss is unlimited. In this case, theoretically, stock can go from $60 to $70 to $100 to $1,000. There's no limit to where those shares can go. And if we're obligating ourselves to sell stock at $60 and we don't already own those shares, we're going to have to go out into the marketplace and get them. If stock is trading $100, we have to pay $100 on the open market to buy those shares in order to meet our obligation at $60. So selling options, our maximum profit is that which we collect. In this case, our maximum loss is unlimited. Now, some of you may be familiar with selling a call against stock that you already own. That's known as a covered call, and the risk-reward with the covered call is substantially different. It's not something that we're going to get into in this presentation, but we definitely have plenty of resources on our OIC website and our OIC YouTube page, specifically detailing covered calls. And if you have any questions on those, we'd be happy to point you in the right direction of those resources. So buying and selling calls, that's kind of a quick refresher of the two. Let's switch to puts. Again, buying puts, we know that when we're buying options, our maximum reward, our maximum risk is going to be that which we put into it. When we buy puts, we have what? We've got the right to sell shares at the strike price. So if I'm buying a 35 strike put and it's costing me $2.25, I'm purchasing the right to to sell stock at $35. that right is going to cost me 2.25. So theoretically, I'm selling those shares out at $32.75. I'm selling stock at 35, but it's costing me $2.25 in order to do so. My break-even point is $32.75. Anything below that, I make money. Anything above it, I'm going to lose. Now, the thing about buying puts is our profit is not unlimited. It is substantial, however. The reason it's not unlimited is because stock can only go to zero. If I sell these shares at 35, the most I'll be able to make on this is $35 because the stock can't go below zero. Obviously, then we back out our premium that we paid, so $32.75 really in this example would be our maximum profit. Our maximum loss, well, that's simple. We're buying an option, so we know that we can't lose any more than we put into it. So $225, that's going to be our maximum loss. And the reason that we might buy a put is twofold. Well, number one is we think the stock is going to go down, and maybe we're looking to take advantage of that. But another reason of buying a put is something called a protective put, where we would buy a put against stock that we own as an insurance policy. If I'm long stock from 35, and I'd like to hold on to that stock if I can because I think it's going to go up, but I'm looking to protect myself in case it goes down, I may buy a put as an insurance policy. So if the stock does go down to 30 or 25 or 20, I can go ahead and sell those shares at my strike price. Again, that's called a protective put, something we're not going to explore in depth, but again, numerous resources on our website and our OIC YouTube channel. The last example we're going to look at is something called a cash secured put. The idea of a cash secured put is we're selling a put option which obligates us to buy shares, but because we would be obligated to buy shares, we want to make sure that we've got the cash to do so. So in this example, stock trading 50, we sell a 45 put for $2. And one of the reasons that we might sell a put in order, in addition to collecting income, is maybe we want to buy the stock, but we think $50 is too high of a price. We think the stock is maybe worth more around the $45 range. We'd love to own the stock, but we would rather own it for $45. So we sell the 45 strike put. If we get assigned, we are going to be required to buy those shares for 45. Now, one of the things about it is we've already got the cash set aside to do so, so we don't have to worry about that. Plus, we collected that $2 premium up front, so theoretically, we're getting those shares for 43. If we don't get assigned and the option simply expires worthless, our maximum profit is going to be that $2, the premium we received. If we do get assigned, then our maximum profit is unlimited because now we are long stock, and obviously sky's the limit as to where that might go. Now, the maximum loss is substantial because we may get assigned and shares not only dip, but significantly decrease. Instead of the stock going down to 45 or 44, and we get assigned, what if they go down to 20? Well, we're still going to be obligated to buy that stock for 45, even though it's trading 20 in the market. So you can see, again, the stock can theoretically go down to zero, so that's why we have a substantial, the potential for a substantial loss. So let's move on to new options listings. With the IPOs as of late over the last couple of years, I know IPOs have tapered off a little bit, but when there is an IPO, people are always asking us, when are they going to list options? When it comes to listing options, it is exclusively the domain of the exchange, of the CBOE, the NASDAQ, the NYSE, etc. It's strictly a decision of the exchange as to whether or not they're going to list options on those particular stocks, on those particular securities. Obviously, they have some requirements. They have criteria that they follow, as you can see here. I'm not going to cover all of them, although some of them are important. Obviously, it has to be listed on a national exchange. And some of you have contacted us to say, hey, I had options on XYZ. It was delisted. What's going to happen to the options? Well, the options get delisted as well because the shares are no longer listed on a national stock exchange. They also have to have at least 7 million publicly shares held or shares outstanding held by the public as opposed to held by insiders. And then you can see here 2,000 shareholders in a minimum of 5 days. But the point being, the exchanges are the ones that decide which options to list on securities. The exchanges are the ones that decide which strikes to offer for trading. The exchanges are the ones that decide which maturities are to offer for trading. So all of those decisions come from the options exchanges. The OIC here, we often act as a liaison between the public and the exchange if you're looking for additional strikes to be added, or if you have questions about what's listed and why, simply shoot us an email and we'd be happy to act on your behalf of that. So new option listing, entirely the power and decision of the exchanges. Buy and sell to open or close, another question that we get often. When it comes to creating a new position or increasing an already existing position, that is known as an opening transaction. So if we're buying to open a long position, we're creating a position that we didn't have, or we're adding to an existing position on a purchase, a long position, that would be buy to open. If we're increasing a short position, that would be sell to open. Or if we're creating a new short position, sell to open. To close is going to be the opposite. When we exit or decrease an existing position, we are going to sell to close or buy to close. So when you initiate a new option trade, let's say we're buying calls, we are going to initiate that trade on our trading platform as buy to open. When we decide to exit that trade, we are going to sell to close. We're exiting or reducing that existing long position. If we're simply selling out a couple contracts, we're reducing the number. Again, sell to close. If we've got 2 option contracts and we're looking to add 2 more, again, that would be a buy to open. So buy to open and sell to open is establishing new positions or increasing existing ones. Sell to close and buy to close is where we exit or reduce our existing short positions. And the reason that those are important is, again, like many things in today's presentation, those reasons are twofold. Number one, you want to make sure that you're entering the order in correctly, because if you're looking to close out your position, you don't want to accidentally add to it. So you want to make sure that when you're in your trading platform that you're indicating your contract appropriately so that it has the proper effect that you intend. The other issue is open interest. When you're increasing a position or when you're decreasing or closing a position, that can often affect the open interest of the contract. And open interest is simply the total number of open positions carried over from one business day to the next. So at the end of today's trading versus overnight into tomorrow morning, the exchanges will tabulate each open position for every option series in existence. They will then forward that information to the OCC, who makes it available on their website. And the reason it's important is because after all of those buys and sells are processed, the OCC will then begin the assignment process for those short positions. So it needs to be an accurate picture as to how many open positions there are and how many of those open positions are eligible for assignment. Open interest is also important is because it can be used, some people use it to spot trends in the marketplace. However, I always like to point out that open interest can be misleading. And the reason is, if you look at our table here, if I'm buying a contract to open and let's say somebody in our audience, let's say Alicia is selling a contract to open, well, then that open interest is going to increase by 1. If I buy one contract to open, Alicia sells one contract to open interest is going to increase by 1. Some people use open interest information to spot bullish or bearish trends. So let me ask you, if open interest is increasing by 1, is there any way for me to tell whether or not that's bearish interest or bullish interest? I may be buying the contract because I'm bullish. Leisha may be selling the contract because she's bearish. So there's not necessarily a clear distinction between bear and bull, as noted by that open interest increasing by 1. So that's why I say that it can be misleading. While OIC doesn't go into a deep dive on open interest, there certainly are plenty of resources out there that do and explain how they can use open interest or how they might use open interest as bearish indicators, bullish indicators, maybe used to spot the top or bottom of a trend and look for a reversal, a trend reversal. But like I said, open interest can be misleading because I don't think it tells you the full picture. But that being said, if both contracts are to open, that open interest will increase by 1. If both contracts are to close, open interest will decrease by 1. Any combination between that is going to be no change. And if you have any further questions on open interest, certainly we'd be happy to talk to you about those. The reason that open interest is important, as I had mentioned, is because at the end of the day, only those contracts that are open can be exercised and assigned. So we talked about how option buyers have rights to buy stock for calls, sell stock for puts, but they can only engage that right or exercise that right, obviously, if they're long the contract, and they exercise that right simply by exercising the option. If the option is deemed to be in the money, which again we'll get to in just a moment, in the money is telling us that the contract has intrinsic value. And Ed spoke a little bit about intrinsic value last week. If I've got a $50 stock and a $45 call, that option intrinsically, inherently, automatically will have $5 of value. That is the intrinsic value of the option. If I can buy stock at 45 and it's trading 50, it is intrinsically, inherently worth at least $5. Now, if it has intrinsic value, we say that option is in the money. So if your option is in the money at expiration, your broker likely will automatically exercise the contract, meaning you don't have to do anything. They have a process in place where your contract will automatically be exercised, and you will pay your strike price times 100, assuming a call, or you will collect your strike price times 100, assuming a put. You will buy shares for calls. You will sell shares for puts. This will happen automatically. To find more out about that process and how it specifically applies to your account with your trading firm, you'll definitely want to reach out to your broker to find out their policies and procedures. But exercise will be automatic if the contract is deemed in the money by at least a penny or more. And let's look at an example here. We've got stock trading $79. Now, me as the investor, I bought a June 19th, 2020 80 strike call, and I paid $1.50 for it. Now, let's go back a little bit. I'm buying a call, 80 strike. I'm paying $1.50 for it. How much does that stock price need to be, or where do those shares need to be in order for me to profit on this trade at expiration? I've got the right to buy shares at 80, but I'm paying $1.50 for that right. So theoretically, I'm buying stock for $81.50. If stock is above $81.50, that's where I'm going to begin making money. And in our example, stock is trading 84 now at expiration. So we exercise our contract. Our broker automatically exercises it. It's in the money. It has $4 of intrinsic value. It's an $80 call, $84 stock. Our strike price is below our share price by $4. So we've got $4 of intrinsic value. We are going to exercise that option and pay our strike price times 100, which is $8,000, and we're going to take delivery of 100 shares of stock. Now, with stock trading 84, we're taking delivery of $8,400 worth of stock that we paid $8,000 for. Our profit, however, is going to be $250 because even though we made $400 on the stock, we paid $150 up front. So our profit is $250. If we do take delivery of those shares, we now have a risk-reward profile of being long 100 shares of stock from 81.5. Stock goes up beyond that, we make money. Stock falls below that in the future, we're going to lose. Or, and here's a key thing that not a lot of people, not a lot of beginners, I should say, realize, or we can simply sell our contract back to the market rather than exercising. If our contract's got $4 of intrinsic value, rather than go through the whole exercise process, we can simply turn around, sell that option back to the market to close, and we collect our profit. We paid $1.50. We sell it out at roughly $4 or so. That gives us an estimated profit of $250. So we still profit the same. Our commissions and fees and et cetera might be a little bit less to simply sell back to close rather than go through the exercise process. And another thing that that we should note that I know Ed did mention last week is that about 72% of all option contracts never live to see expiration. 72% of all option contracts get closed back out in the market. Only about 10% actually get exercised. So rather than exercising this contract, we might just choose to trade it back to the market and take our profit that way. Now let's look at the flip side. As a seller, remember we've got the obligation to sell stock for calls or buy stock for puts. If we get assigned, that exercise notice that we get assigned, that's going to come from our broker. And what it's going to happen, the flip side to our previous example, now rather than buying that call and paying $1.50, now Leisha sold that call and collected $1.50. So same scenario, several weeks later, stock's trading 84. Leisha gets assigned on that contract. She's going to collect her strike price times 100, $8,000, and she is going to have to deliver those shares. So she delivers $8,400 worth of stock and collects $8,000 for that sale. Now she also collected $250 up front, so that she collected $150 up front. That gives her a $250 profit. If she remains short stock, she now has the risk-reward profile of being short 100 shares from 81.5. Now, again, she can simply, rather than risk assignment, she can simply buy that contract back and kind of bite the bullet. And I think I may have misspoke earlier. Her loss is $250. She collected, theoretically, $8,000 from the stock, $150 from the premium, but delivered $8,400 worth of value. So she's got a $250 loss on the stock. She could always turn around and buy back that option to close from the market for, say, $4. She collected $1.50. She's got to pay $4 to get it back. That's going to be that $250 loss. Other things that she can do when you have a loss in options, you could certainly manage the position. She could, roll that option out to another month, look for a little bit more time in order for her forecast to come true. Remember, her forecast is that she thinks share price is going to go down. That's why she sold that call, or one of the reasons why she may have sold that call. And in this case, her forecast, it was just the opposite. Stock actually went up. If she thinks that she just needs a little bit more time for those shares to come back down, she can simply close out her June position and maybe roll it out a few more weeks or even a few more months if she should so choose to do so. Now, earlier I mentioned American style expiry. There's two exercise styles when it comes to U.S. listed options. There's American, in which I had mentioned the option buyer can exercise at any time during the life of the option and for any reason. They don't necessarily have to exercise their contract if it's in the money. They can choose to exercise their contract if it's out of the money. The option buyer is in the driver's seat. They can exercise at any time for any reason, whether or not it makes sense to you. The opposite side, they have that right. They control the card, so to speak. And because they can exercise their contract at any time, that means that the short side of the trade, the seller, can be assigned at any time. And when it comes to an options calendar, it can happen any trading day of the week. Usually with calls, it is not uncommon to see early exercises occur the day before a stock goes ex-dividend. The reason being is, as I mentioned before, only shareholders receive dividends. So if you exercise your call in time and take delivery of those shares, now you are entitled to that dividend. So if I've got an option, if I'm long a call that's expiring next week, but the company that upon which I bought those calls is paying a dividend and the X date is tomorrow, then in order for me to collect that dividend, I've got to become a shareholder. So I would exercise my option today, take delivery of the stock, and exercise my contract early, and now I'm entitled to that dividend. So American-style options exercise at any time for any reason. The counterpart of that would be European style, and this doesn't have anything to do with geography. So, certainly we get asked the questions, I'm buying options on a foreign company traded on a U.S. market. Does that mean it's American or European style? And the answer is the geography is irrelevant. It's simply the exercise style that applies. So European options, that's where you're going to find most of your broad-based indices. American style, that's going to be all of your equities and ETFs. European options can only be exercised and can only be assigned on expiration. So exercise can only occur at expiration. Typically, it's going to be the third Friday of the month for monthly contracts. But now with the advent of weekly contracts, we've got Monday, Wednesday, and Friday expirations. So if you've got a weekly contract that expires on a Wednesday, you can only exercise that contract on a Wednesday, assuming European style. And again, that's going to be your indices, your SPX, NASDAQ, Russell, etc. Settlement style differs from security to security as well. The ETFs and the equities, those are going to be physically settled, meaning if I'm buying a call, I'm going to take delivery of stock. The securities are going to be credited to my account, and the cash is going to be debited from that account. The flip side is cash. Again, those are going to be most of your broad-based indices, where the difference, the intrinsic value of the contract is going to be paid out between the strike price and the settlement price. You are actually going to receive cash and only cash when you exercise your contract or when you get assigned on that contract. And the amount of cash that you receive or the value of those shares of stock that you receive, that's going to depend on the moneyness that we talked about earlier. So when it comes to calls, Our calls are going to be in the money if the strike price is below the stock price. You can see that in green. We've got our stock price of $50. Any strike price, regardless of the month, any strike price below $50 is going to be deemed in the money. If I have a $40 call and the stock is trading $50, I can buy shares today for $40, turn around and sell them for $50. That is an automatic $10 profit just based on that strike price. Therefore, it's deemed in the money as it has intrinsic value. Anything at the money or out of the money will have no intrinsic value, and any value in that option is going to be considered time value. Time value is going to be time until expiration, value of dividends or interest rates, and implied volatility. Concepts that certainly matter when it comes to the price of the option, but again, a little bit more of a deeper dive and something that we're going to be exploring a little bit more in our next presentation when we're talking about buying options. So in the money for calls, it's when our strike price is below the stock price. At the money and out of the money is where our strike price is at or above the stock price. Those calls, those options will have no intrinsic value and extrinsic or time value only. With puts, it's going to be the opposite. Our puts are going to be in the money if our strike price is above the stock price. And when you think about it, it makes sense. With puts, we want to sell the stock at $55 if it's trading $50 in the market. We can sell it at $55. We can buy it back for $50. That's going to give us $5 of intrinsic value. Therefore, with puts, if the strike price is above the stock price, we are in the money. Anything else at or out of the money, those options are going to have no intrinsic value. So before we get to questions from the audience, we've got about 12 minutes or so, so I'm glad that we've got plenty of time to take some questions. Let's do a kind of a knowledge check wrap-up. When entering an order to exit a long position, the trader will mark the order how? We're entering an order to exit an existing long position. Are we going to be buying to open, sell to open, buy to close, sell to close? We've got an existing position that we're looking to exit, so we know that we're looking to close. It's a long position, so we're going to look to do the opposite. We're going to have to sell to close to exit that position. Hope everybody got that one right. Let's look at our next. If both buyer and seller are creating a new position, how will open interest be affected? If you remember the graph that we looked at earlier, buyer to open, seller to open, both creating a new position, open interest will increase. And again, it can be misleading. We don't know what the motivations of the buyer in order to purchase that contract or the motivations of the seller. So it can be misleading as to what open interest numbers dictate. To avoid assignment, sellers can often decline by contacting their broker ahead of time. Is this true or false? Again, letters and emails that we receive from time to time saying I'm short calls on this stock, I don't want to get assigned. Can I simply notify my broker that I refuse assignment? The answer to that is unequivocally false. Buyers have the right, sellers have the obligation. Sellers have no say in whether or not they get assigned on the contract. The only way a seller can avoid assignment is to close out their position ahead of time because only open contracts can be assigned. So the best way to avoid assignment, as my friend and partner Bill Ryan says, best way to avoid assignment is not to have an assignable position. And then lastly, for a put to be considered in the money, the strike price must be above the stock price, true or false. For a put to be considered in the money, the strike price should be above the stock price. So we know with puts that we want to sell the shares above where they're trading in the market. So if the strike price is above the stock price, we have the right to sell stock at $44, let's say, and stock is trading $40, that strike price is above the share price, and that would be considered in the money. Now, let's take a look at some questions that we have. Under what conditions, this is coming from Don, under what conditions would a seller of a put or call be obligated to pay a dividend? Well, puts generally, a seller of a put would not be obligated to pay the dividend because when we sell puts, remember, if we get assigned, we pay the strike price times 100 and we collect or we receive shares of stock. If we receive those shares, we're also going to receive the dividend. So the likelihood of being assigned on a put when there's a dividend in play is fairly slim because of that concept right there. Now, when it comes to calls, completely different story. We briefly talked about time value and intrinsic value. If I exercise a contract, the only thing I'm going to receive is the intrinsic value of the contract. Remember, I exercise it, I receive my strike price times 100, and I receive the stock. $50 call on a $52 stock, I exercise my call. I now own shares from 50, theoretically not including the premium that I paid. I own shares from 50, they're trading 52. So that's the intrinsic value. If that option is trading in the market for $2.20, it would make more sense for me to simply turn around and sell that contract back to the market, collect the $2.20, rather than exercise early and collect the $2 in profit from buying and selling the shares. Now, that being said, if there's a dividend in play where the amount of the dividend exceeds the value or the time value of the option, then it would make sense for me to exercise early. In the example that I just used, stock trading 52, I've got a $50 call that's trading $2.20 in the market. My intrinsic value is $2, the difference between the share price and the strike price. Everything else, the time value is 20 cents, $2.20 premium, $2 intrinsic, 20-cent time value. Again, if I exercise my contract, I lose that 20 cents. But what if, by exercising that contract and becoming a shareholder, the dividend that I receive is going to be 50 cents? The company is paying a 50-cent dividend, but only to shareholders. So if I exercise my contract early, I forego 20 cents in time value of the option, but I collect 50 cents of dividend now that I'm a shareholder. So by exercising that contract early and foregoing that time value, I'm actually gaining additional value because of that dividend. So, Don, that's the example of, as a short call writer, one of the ways that you can determine whether or not you would be at risk of early assignment in the face of a dividend is determining the time value of your option contract versus the anticipated amount of the dividend. Let's take a look at some other questions that we have. This is from John. Regarding auto execution, I'm assuming he means auto exercise. Will the broker auto exercise an in-the-money contract even if the contract expiration is days or weeks in the future? John, I am happy to say the answer to that is no. Auto exercise only occurs on expiration. Now, as an option holder, you can choose to exercise your contract at any time for any reason, but the broker will only do it automatically at expiration. If you choose to do it early, you will have to notify your broker explicitly. You'll have to, they will have a procedure for you to notify them in advance or your intent to exercise your contract ahead of time. And again, another terrific reason to contact your broker and be familiar with their policies and procedures when it comes to exercise and the assignment process. Let's see, another question regarding exercise. Can the person on the other side of the option contract identify the person who exercised their option? Absolutely not. One of the functions the OCC plays, the Options Clearing Corporation, is they are the counterparty to every buyer and seller out there, meaning, again, using the example of me and Leisha, or Leisha and I earlier, if Leisha and I do an option contract together, I buy a call, she sells it. Once that option clears the OCC, the relationship that Leisha and I have no longer exists. It is severed. Now OCC is my counterparty. They are the seller to my option. OCC is now the buyer to Leisha's option. And the reason being, if I were looking to exercise my contract and for some reason Leisha were unable to fulfill her obligation, well, that wouldn't be fair to the option holder. So the OCC makes sure that the terms of those contracts are fulfilled. They sever the relationship between buyer and seller. So that being said, when it comes to assignment, the assignment is simply on a random basis. I will notify my broker, or my broker will automatically exercise my contract for me because it is in the money. My broker will then notify OCC that they are exercising a long position in a particular stock at a particular strike price. OCC will then randomly assign a trading firm who is representing the exact opposite short position of my long contract. That brokerage firm will then randomly assign an investor who has that exact short position opposite to my contract. So not only will you not know who exercised your contract, but frankly, it's fairly irrelevant who did. Doesn't matter who did. You've got the obligation to accept the assignment for any reason. So that is how that works. Let's. Another one, Refont is asking, does SPX, the S&P 500 index, follow European style? Absolutely it does. The SPX is European style cash settled, meaning that you can only exercise that contract on expiration, whether it's Monday, Wednesday, or Friday, whether it's a monthly contract or a weekly. It's also cash settled. So if the S&P, for example, closes at, if I've got a 3,300 call and the S&P closes at 3,350, my contract is in the money by $50. Times 100 is going to be $5,000 worth of intrinsic value, and I will collect $5,000 in cash. There's going to be no shares change hands, nothing like that. It's simply going to be cash settled. Now, taking this a step further about the SPX, it is AM settled. What that means is that on the opening print, or based on the opening print the morning of expiration, the contract is going to settle, meaning that the day before, if you've got a monthly contract and it expires Friday morning, Thursday at the close of business, or prior to the close of business Thursday, is the last time you have to trade or exit or manage that position. Once Thursday's business has closed, that contract is as good as done, and it will expire first thing Friday morning. We've got about 30 seconds left, so if you don't mind, I'd like to do one more question. Let's take a look. Last question here. Let's see. Well, folks, I apologize. It looks like my computer just shut down. I certainly hope that I didn't lose you. If I did, our apologies. It looks like we got disconnected. But take a look at our, please take a look at our website for upcoming events. We have 2 presentations in February where we'll be discussing buying options and selling options as well. Our website and our OIC YouTube channel has plenty of resources and videos and archives of past presentations, and definitely make use of our investor services team for any of your options-related questions. You can live chat with us on the website or contact us via email at options@theocc.com. Thank you for joining me today. I certainly enjoyed presenting. I hope you got a lot out of it, and feel free to contact us again. Have a great day. Thanks.